Hi friends, welcome to this exciting blockchain tutorial. You're here because you're curious about the cryptocurrencies and you want to know how blockchains work, right? Blockchain is certainly one of the most versatile and useful technologies currently available, and now is the excellent time to enter this sector. The blockchain industry is booming with opportunity. It's one of the fastest growing, highest paid fields in technology. This tutorial has been prepared for professionals aspiring to learn the basics of blockchain. We have tried to explain blockchain concepts in easy and precise words. This course is going to give you great understanding for the students and professionals aspiring to make a career in the blockchain technology. So let's start the fun. So friends, we hear a lot about the cryptocurrencies. What is a cryptocurrency? Cryptocurrency is digital money. A cryptocurrency is a form of digital currency that can be used to buy goods and services. It can also be used to verify the transfer of assets and secure financial transactions using cryptography. One of the cryptocurrency's most important advantages over normal currencies is that they are not controlled by any central authority. Without a central point of failure or a vault, the funds cannot be hacked or stolen. Let's understand it in easy words. As an analogy, think of the popular Microsoft Excel spreadsheet program. You can make changes to the data on your own that may differ from earlier versions of the spreadsheet that are shared with others. But if you make changes to a Google Sheets document, on the other hand, those changes also show up in every other shared copy. Similarly, the shared and distributed nature of cryptocurrencies keeps everyone on the same page. Many companies have issued their own currencies, often called tokens, and these can be traded specifically for the good or service that the company provides. Think of them as you would arcade tokens or casino chips. More than 10,000 different cryptocurrencies are traded publicly, and cryptocurrencies continue to rise. The total value of all cryptocurrencies as of June 2021 was more than $1.7 trillion. As you can see on the screen, these are just some of the cryptocurrencies: Bitcoin, Litecoin, Ethereum, Zcash and many more. A question comes up: how do I buy cryptocurrency? While some cryptocurrencies, including Bitcoin, are available for purchase with US dollars, others require that you pay with Bitcoins or another cryptocurrency. To buy cryptocurrencies, you'll need a wallet, an online app that can hold your currency. Generally, you create an account on an exchange, and then you can transfer real money to buy cryptocurrencies such as Bitcoin or Ethereum. Now let's talk a bit about Bitcoin. First, what is Bitcoin? Bitcoin is an online financial system or a digital currency. These are often known as virtual currency or cryptocurrency. Bitcoin is a cryptocurrency, a type of digital, private money that operates without the involvement of a bank or government. Bitcoin trades on online exchanges, and since its price has mushroomed since its 2009 debut, it's increasingly attracting investors' interest. As an investment asset, Bitcoin offers capital appreciation and an inflation hedge, but its volatile price swings make it a high-risk, long-term investment. These also follow similar transaction rules like checks, cash, and DDs, but Bitcoins are not visible, fiat currency. Bitcoin has created a lot of buzz for the past several years around the globe. Some fun facts about Bitcoin. Do you know, the first Bitcoin purchase was for pizza? Also, if you lose your Bitcoin private key, you lose your Bitcoin. There will only ever be 21 million Bitcoin. Also, Bitcoin is made of 31,000 of codes. Last, the estimated year that the last Bitcoin will be mined is 2140, based on the Bitcoin block having a dividing frequency of 4 years. After some fun, let's learn something about blockchain. As we can see on the screen, a blockchain is a record of transactions. Like a traditional ledger, these transactions can be any movement of money, goods or secure data, a purchase at a supermarket. Blockchain refers to a decentralized public ledger that records transactions across many computers. Blockchain has no central point. All information is stored in many different computers at once across the internet, and this makes it hard for anyone to break into a single computer or steal the data. Think of the traditional way of sharing documents with collaboration. One would have to send a Word document to another person and wait for them to make edits and send the document, so that they can view it. You cannot edit the data while it's in the hands of the other recipient. You have to wait for them to finish and send. That's how databases work today. Blockchain, sometimes referred to as distributed ledger technology (DLT), makes the history of any digital asset unalterable and transparent through the use of decentralization and cryptographic hashing. Let's understand the blockchain concept through a simple analogy. A simple analogy for understanding blockchain technology is a Google Doc. When we create a document and share it with a group of people, the document is distributed instead of copied or transferred. This creates a decentralized distribution chain that gives everyone access to the document at the same time. No one is locked out awaiting changes from another party, while all modifications to the doc are being recorded in real time, making changes completely transparent. Of course, blockchain is more complicated than a Google Doc, but the analogy is fine. Blockchain consists of 6 important concepts. Node, user or computer within the blockchain architecture. Each has an independent copy of the whole blockchain ledger. Transaction, smallest building block of a blockchain system, records information that serves as the purpose of blockchain. Block, a data structure used for keeping a set of transactions which is distributed to all nodes in the network. Chain, a sequence of blocks in a specific order. Miners, specific nodes which perform the block verification process before adding anything to the blockchain structure. Consensus or consensus protocol, a set of rules and arrangements to carry out blockchain operations. There are several key steps a transaction must go through before it is added to the blockchain. Blockchain transaction starts with authentication. The original blockchain was designed to operate without a central authority, i.e., with no bank or regulator controlling who transacts, but transactions still have to be authenticated. Each user has their own private key and a public key that everyone can see. Second step in transaction is authorization, which means, once the transaction is agreed between the users, it needs to be approved, or authorized, before it is added to a block in the chain. So as part of authorization, a block is created, then it is sent to all the nodes for approval and then nodes need to validate the transaction. Next steps is proof of work, POW. Proof of work requires the people who own the computers in the network to solve a complex mathematical problem to be able to add a block to the chain. Solving the problem is known as mining, and miners are usually rewarded for their work in cryptocurrency. The block is then added to the existing blockchain and entire network is updated with this transaction information. By now, you might be wondering what's the difference between Bitcoin and blockchain. So first, to start with, blockchain is a technology or a distributed database, whereas Bitcoin is one of the cryptocurrencies using blockchain for secure and anonymous transactions. Then, blockchain is a transparent mechanism, whereas Bitcoin operates on anonymity. Thirdly, blockchain has a much more extensive use, while Bitcoin is only restricted to exchange in digital currencies. And finally, blockchain transfers proprietary information, digital assets, rights, whereas Bitcoin is only used to transfer digital currencies. There is another important comparison which we need to understand: blockchain vs database. This difference is fairly straightforward. Blockchain is decentralized, whereas the database is centralized. Blockchain is permissionless, whereas the database required permission. Blockchains are slow, whereas databases are fast. Blockchain has only insert operation, whereas the database has CRUD, create, read, update, and delete operation. Anyone with the right proof of work can write on the blockchain, whereas in databases, only entities are entitled to read or write can do so. Let's now go through the smart contracts. A smart contract is a computer code that can be built into the blockchain to facilitate, verify, or negotiate a contract agreement. Smart contracts are simply programs which are stored on a blockchain. These programs run when predetermined conditions are met. Smart contracts work by following simple if-when-then statements that are written into code on a blockchain. A network of computers executes the actions when predetermined conditions have been met and verified. These actions could include releasing funds to the appropriate parties, registering a vehicle, sending notifications, or issuing a ticket. The blockchain is then updated when the transaction is completed. That means the transaction cannot be changed, and only parties who have been granted permission can see the results. Smart contracts operate under a set of conditions that users agree to. When those conditions are met, the terms of the agreement are automatically carried out. Say, for example, a potential tenant would like to lease an apartment using a smart contract. The landlord agrees to give the tenant the door code to the apartment as soon as the tenant pays the security deposit. Both the tenant and the landlord would send their respective portions of the deal to the smart contract, which would hold on to and automatically exchange the door code for the security deposit on the date the lease begins. If the landlord doesn't supply the door code by the lease date, the smart contract refunds the security deposit. This would eliminate the fees and processes typically associated with the use of a notary, third-party mediator, or attorneys. Let's now learn, what is decentralization? Well, as you might be aware, decentralization is not a new concept. When building a technology solution, three primary network architectures are typically considered: centralized, distributed, and decentralized. In blockchain, decentralization refers to the transfer of control and decision-making from a centralized entity, individual, organization, or group thereof, to a distributed network. Decentralized networks strive to reduce the level of trust that participants must place in one another, and deter their ability to exert authority or control over one another in ways that degrade the functionality of the network. Decentralization provides a trustless environment, improves data reconciliation, and optimizes resource distribution, reduces points of weakness. What are the ledgers in blockchain? As we can see on the screen, a distributed ledger is a type of database that is consensually shared, replicated, and synchronized among the members of a decentralized network. All the information on this ledger is securely and accurately stored using cryptography. This information can be accessed by using keys and cryptographic signatures. The distributed ledger allows transactions to have public witnesses, which makes cyber attack more difficult. It records the transactions, such as the exchange of assets or data, among the participants in the network. There is no central authority, or third-party mediators such as a financial institution or government agencies are involved. Every record in the distributed ledger has a timestamp and unique cryptographic signature. It makes the ledger an auditable and immutable history of all transactions in the network. Further, if any alterations made to the ledger, they are reflected and copied to all participants in seconds or minutes. Recently you might have heard about the idea to move from an Ethereum consensus based on the proof-of-work system to one based on the so-called proof-of-stake. Essentially, proof-of-work is used to determine how the blockchain reaches consensus. In other words, how can the network be sure that the transaction is valid and that someone isn't trying to do bad things, such as spend the same funds twice? Proof of stake will make the consensus mechanism completely virtual. While the overall process remains the same as proof of work, the method of reaching the end goal is entirely different. In PoW, the miners solve cryptographically hard puzzles by using their computational resources. In PoS, instead of miners, there are validators. The validators lock up some of their ether as a stake in the ecosystem. So let's understand both as shown on the screen. Proof of work is the original consensus algorithm in a blockchain network. The algorithm is used to confirm the transaction and creates a new block to the chain. Proof of work requires the people who own the computers in the network to solve a complex mathematical problem to be able to add a block to the chain. Solving the problem is known as mining, and miners are usually rewarded for their work in cryptocurrency. Whereas proof of stake was created as an alternative to proof of work. Proof of work requires huge amounts of energy. Proof of stake gives mining power based on the percentage of coins held by a miner. Bitcoin, the largest cryptocurrency, runs on proof of work rather than proof of stake. How blockchain prevents double spending problem. First, let's understand the double spending problem. Double spending is the risk that a digital currency can be spent twice. Double spending occurs when a blockchain network is disrupted and cryptocurrency is essentially stolen. The most common method of double spending is when a blockchain thief will send multiple packets to the network, reversing the transactions so that it looks like they never happened. Blockchain prevents double spending by time-stamping groups of transactions and then broadcasting them to all of the nodes in the Bitcoin network. As transactions are time-stamped on the blockchain and mathematically related to the previous ones, they are irreversible and impossible to tamper with. Let's understand what is blockchain Merkle tree. Blockchain Merkle tree is also referred to as binary hash trees. A Merkle tree is a data structure that is used in computer science applications. In Bitcoin and other cryptocurrencies, Merkle trees serve to encode blockchain data more efficiently and securely. As shown, this structure resembles a tree. In the diagram below, T designates a transaction, H a hash. Note that the image is highly simplified. An average block contains over 500 transactions. What are the Bitcoin forks and SegWit? Bitcoin forks is a change to the digital currency software which creates two different paths of the blockchain with a shared history. The forks can be temporary, or lasting for a few minutes, or can be permanent. The changes made to the Bitcoin software can require either a soft fork or hard fork. Whereas segregated witness, a SegWit, is the process by which the block size limit on a blockchain is increased by removing signature data from Bitcoin transactions. Segregate means to separate, and witnesses are the transaction signatures. Hence, segregated witness, in short, means to separate transaction signatures. You might have heard many times, what is Bitcoin mining? Mining serves two purposes: to create new coins and to maintain a log of all transactions of existing digital tokens. It is performed using very sophisticated computers that solve extremely complex computational math problems. By mining, you can earn cryptocurrency without having to put down money for it. Bitcoin miners receive Bitcoin as a reward for completing blocks of verified transactions, which are added to the blockchain. Mining rewards are paid to the miner who discovers a solution to a complex hashing puzzle first, and the probability that a participant will be the one to discover the solution is related to the portion of the total mining power on the network. You need either a GPU, graphics processing unit, or an application-specific integrated circuit (ASIC) in order to set up a mining rig. To earn bitcoins, you need to meet two conditions. One is a matter of effort, one is a matter of luck. 1. You have to verify 1 megabyte worth of transactions. This is the easy part. 2. You have to be the first miner to arrive at the right answer, or closest answer, to a numeric problem. This process is also known as proof of work. How much a miner earns? The rewards for Bitcoin mining are reduced by half every 4 years. When Bitcoin was first mined in 2009, mining one block would earn you 50 BTC. In 2012, this was halved to 25 BTC. By 2016, this was halved again to 12.5 BTC. On May 11, 2020, the reward halved again to 6.25 BTC. In November of 2020, the price of Bitcoin was about $17,900 per Bitcoin, which means you'd earn $111,875, 6.25x 17,900, for completing a block. Time to learn about types of blockchain networks. There are several ways to build a blockchain network. They can be public, private, permissioned, or built by a consortium. First is the public blockchain networks. A public blockchain is the permission-less distributed ledger technology where anyone can join and do transactions. It is a non-restrictive version where each peer has a copy of the ledger. This also means that anyone can access the public blockchain if they have an internet connection. One of the first public blockchains that were released to the public was the Bitcoin public blockchain. It enabled anyone connected to the internet to do transactions in a decentralized manner. Second, private blockchain networks. Examples of public blockchain: Bitcoin, Ethereum, Litecoin, Neo. What are the use cases? Voting and fundraising. A private blockchain network, similar to a public blockchain network, is a decentralized peer-to-peer network. It works in a restrictive environment, i.e., a closed network. It is also a permissioned blockchain that is under the control of an entity. Private blockchains are amazing for using at a privately held company or organization that wants to use it for internal use cases. A private blockchain can be run behind a corporate firewall and even be hosted on premises. Examples of private blockchain: multi-chain, Hyperledger Fabric, Hyperledger Sawtooth, Carda. What are the use cases? Supply chain management, asset ownership and internal voting. Third, consortium blockchains. A consortium blockchain, also known as federated blockchains, is a creative approach to solving organizations' needs where there is a need for both public and private blockchain features. In a consortium blockchain, some aspects of the organizations are made public, while others remain private. Multiple organizations can share the responsibilities of maintaining a blockchain. These pre-selected organizations determine who may submit transactions or access the data. A consortium blockchain is ideal for business when all participants need to be permissioned and have a shared responsibility for the blockchain. Examples of consortium blockchain are Marco Polo, Energy Web Foundation, IBM Food Trust. What are the use cases? Banking and payments, research and food tracking. Fourth, hybrid blockchain. Hybrid blockchain is best defined as a combination of a private and public blockchain. It has use cases in an organization that neither wants to deploy a private blockchain nor public blockchain and simply wants to deploy both worlds best. Example of hybrid blockchain are DragonChain, Shinfin's hybrid blockchain. What are the use cases? Real estate, retail and highly regulated markets. Let's now learn blockchain as a service or BaaS. Blockchain as a service (BaaS) refers to third-party cloud-based infrastructure and management for companies building and operating blockchain apps. It is the third-party creation and management of cloud-based networks for companies in the business of building blockchain applications. These third-party services are a relatively new development in the growing field of blockchain technology. The application of blockchain technology has moved well beyond its best-known use in cryptocurrency transactions and has broadened to address secure transactions of all kinds. BaaS functions like a sort of web host, running the back-end operation for a blockchain-based app or platform. BaaS may be the catalyst that leads to the widespread adoption of blockchain technology. Major players in the BaaS space include Microsoft, Amazon, R3, Paystand. Some of the most common features offered in blockchain as a service platforms are platform architecture management, modular, pre-configured networks and infrastructure, easy setup workflow, middleware for monitoring and development for app building, dashboard to view and analyze, auditable transaction record, and built-in connections to needed services. Let's discuss some of the important use cases or real-life applications of blockchain. Banking and finance is the foremost industry for application of blockchain. Perhaps no industry stands to benefit from integrating blockchain into its business operations more than banking. Financial institutions only operate during business hours, 5 days a week. That means if you try to deposit a check on Friday at 6 p.m., you will likely have to wait until Monday morning to see that money hit your account. Even if you do make your deposit during business hours, the transaction can still take 1 to 3 days to verify due to the sheer volume of transactions that banks need to settle. Blockchain, on the other hand, never sleeps. By integrating blockchain into banks, consumers can see their transactions processed in as little as 10 minutes, basically the time it takes to add a block to the blockchain, regardless of holidays or the time of day or week. With blockchain, banks also have the opportunity to exchange funds between institutions more quickly and securely. In the stock trading business, for example, the settlement and clearing process can take up to 3 days, meaning that the money and shares are frozen for that period of time. European bank Santander and its research partners put the potential savings at $15 billion to $20 billion a year. 3 Capgemini, a French consultancy, estimates that consumers could save up to $16 billion in banking and insurance fees each year through blockchain-based applications. Currency is the second application of blockchain. Blockchain forms the bedrock for cryptocurrencies like Bitcoin. The US dollar is controlled by the Federal Reserve. Under this central authority system, a user's data and currency are technically at the whim of their bank or government. If a user's bank is hacked, the client's private information is at risk. If the client's bank collapses or they live in a country with an unstable government, the value of their currency may be at risk. In 2008, some of the banks that ran out of money were bailed out partially using taxpayer money. These are the worries out of which Bitcoin was first conceived and developed. By spreading its operations across a network of computers, blockchain allows Bitcoin and other cryptocurrencies to operate without the need for a central authority. This not only reduces risk but also eliminates many of the processing and transaction fees. It can also give those in countries with unstable currencies or financial infrastructures a more stable currency with more applications and a wider network of individuals and institutions they can do business with, both domestically and internationally. The healthcare sector. Healthcare providers can leverage blockchain to securely store their patients' medical records. When a medical record is generated and signed, it can be written into the blockchain, which provides patients with the proof and confidence that the record cannot be changed. These personal health records could be encoded and stored on the blockchain with a private key, so that they are only accessible by certain individuals, thereby ensuring privacy. Supply chain area is also a good example of blockchain applications. Suppliers can use blockchain to record the origins of materials that they have purchased. This would allow companies to verify the authenticity of their products, along with such common labels as organic, local, and fair trade. As reported by Forbes, the food industry is increasingly adopting the use of blockchain to track the path and safety of food throughout the farm-to-user journey. One area we have not mentioned is social networking. Social networking has become an integral part of our daily lives. According to Statista, it was estimated that in 2019, there will be more than 2.77 billion social media users worldwide. The introduction of blockchain in social media will be able to solve inherent problems related to privacy violations, notorious scandals, data control and content relevance. Hence the blending of blockchain in the social media domain is another emerging technology trend. Implementation of blockchain in social media will ensure that all the published data in the social media domain remain untraceable and cannot be duplicated, even after its deletion. Moreover, users will get to store data more securely and maintain their ownership. Blockchain technology ensures that the power of content relevance lies in the hands of those who created it, instead of the platform owners, making users feel more secure. Next area is voting. Blockchain could be used to facilitate a modern voting system. Voting with blockchain carries the potential to eliminate election fraud and boost voter turnout, as was tested in the November 2018 midterm elections in West Virginia. Using blockchain in this way would make votes nearly impossible to tamper with. The blockchain protocol would also maintain transparency in the electoral process, reducing the personnel needed to conduct an election and providing officials with nearly instant results. This would eliminate the need for recounts or any real concern that fraud might threaten the election. Friends, all we can see right now, the blockchain revolution continues. The growth of Bitcoin and blockchain technology has been rapid. Even those who haven't heard of cryptocurrency are looking to invest and explore this field. Friends, this tutorial is just an effort to provide an overview of important concepts of blockchain technology. For those who are thinking or planning to learn and enter into blockchain technology, it should be helpful. Please write in the comment if you want something similar or different content. And please, don't forget to like, share and subscribe. Thanks for watching and loving the videos. See you in the next one.